Most traders lose money, not because they don't work hard, but because they don't understand how smart money actually moves. Today, we're going to change that. We're diving into some of the most powerful ICT concepts that every serious trader should understand. All right, let's jump in. It's inefficiency, or what's commonly called the fair value gap. This is a core principle in smart money concepts, SMC, and it's all about how price moves when big institutions like banks, hedge funds, and large brokers enter the market. These players are what we call smart money, and they trade with massive order sizes. When they execute their trades, it often causes aggressive price movements that leave clear footprints on the chart. So how do we spot these smart money moves? One way is by identifying imbalances or inefficiencies in price, specifically fair value gaps. Now, don't worry, these all mean roughly the same thing. A fair value gap happens when price moves so fast that there's a gap left between candlestick wicks. In other words, there's no trading activity in that area, just a big jump in price. Here's how it works. A fair value gap is typically formed when you see a 3-candle pattern, and the wicks of the first and third candles don't overlap. This gap between the wicks shows a lack of trading balance. It's an area where either buyers or sellers dominated completely, leaving the other side behind. Look at this chart. In the first example, you'll see a bullish fair value gap where price surged upward and left a clean gap between the candle shadows. This tells us of the move was sell side inefficient, meaning sellers didn't have a chance to respond. Now compare it to the second example. Here, the wicks of the candles do overlap. That means the price action was balanced and there's no fair value gap. That's what we call an efficient price. But here's where it gets interesting and useful for us as traders. Whenever price leaves behind a fair value gap, it often comes back to that zone to fill the imbalance. Why? Because the market seeks equilibrium, a balance between buyers and sellers. These gap areas act like magnets, drawing price back in before continuing its move. This makes fair value gaps high probability zones for entries or exits. In smart money trading, we treat them as potential supply and demand zones, offering us excellent trading opportunities, but only if we know how to read them correctly. Let's walk through an example to see how this actually plays out. Here, price is clearly moving in an uptrend. As it climbs, we start to notice fair value gaps forming on the way up. These gaps signal a buy-side imbalance and sell-side inefficiency. That simply means buyers are in control and sellers didn't get a chance to fully participate. Now look just beneath the fair value gap. You'll often find demand zone sitting right there. Why is that important? Because that demand zone is what triggered the imbalance in the first place. It's the origin of the strong bullish move. Now let's imagine price pulls back. It forms another demand zone, but here's the key. This second zone doesn't create an imbalance. The price action around it was balanced, efficient, and clean. So what's the difference? When you compare the two, the first demand zone, the one that caused the imbalance, is way more powerful. Why? Because that fair value gap acts like a magnet. The market wants to come back and fill that inefficiency, and it often does so with precision. That's why when you're analysing the chart, your focus should be on the zones that caused the imbalance, not just any random support or demand area. Those are the zones where smart money entered, and that's where we have the highest probability of seeing a reversal or continuation. To wrap this up, imbalance is one of the strongest signals in smart money concepts. It's usually one of the first things we look for when analysing price action. But remember, it's not a standalone signal. Just like any other concept, it works best when combined with other confluences, like market structure, liquidity, or timing. Use it wisely, and it can seriously level up the quality of your trades. Now let's move on to the second core concept. Liquidity. Liquidity in simple terms is all about where stop losses are placed. Wherever traders put their stops, that's where liquidity lives, and smart money knows this. In fact, smart money often intentionally moves the market toward those zones to trigger stop losses and create the perfect entry for their own positions. Let me explain. Every swing high and swing low on the chart holds liquidity. Why? Because that's exactly where retail traders are taught to place their stop losses. For example, if price is trending upward and then pulls back, many traders will jump in with long positions and place their stops just below the previous swing low, expecting the uptrend to continue. Similarly, as price approaches a swing high, some traders take profits, while others go short thinking it's a resistance zone, again, leaving liquidity above that high. So what does smart money do? They'll often push price just beyond those swing points to trigger stop losses, grabbing liquidity, and then reverse the market in their favor. This process is known as a liquidity sweep, and it's one of the cleanest signals that smart money is active. Here's how we use this knowledge to our advantage. Let's say price forms a bullish engulfing candle during a pullback. Many retail traders will see that and say, perfect, bullish signal, and they jump in long with their stops just below the engulfing candle. But as smart money traders, we do the opposite. We wait. Instead of entering immediately, we look for a demand zone sitting right below that candle. Why? Because if price sweeps below the engulfing candle, taking out all those stop losses, it taps into that demand zone, and that's where we want to be ready to enter. This gives us a cleaner, smarter entry with tighter risk and better timing. So remember, smart money doesn't chase price. It hunts for liquidity, waits for stop losses to be swept, and only then enters the market. That's how they stay ahead. And it's how we should trade too. Let's take liquidity one step further. There are many different forms of liquidity in the market, but the ones we pay the most attention to are equal highs and equal lows. Now, what does that mean exactly? Equal lows are formed when price creates multiple swing lows at around the same level. This could be a double bottom or even a triple bottom. These areas look like strong support zones on the chart. Similarly, equal highs are created when price tops out multiple times at the same resistance level. To retail traders, these zones look like great entry points. For example, when price taps into equal lows, many retail traders see it as a strong support area. They go long, expecting a bounce, and they place their stop losses just below the equal lows. On the flip side, in a downtrend, when price approaches equal highs or resistance, retail traders go short, thinking it's a safe place to sell. And again, they place their stop losses just above those equal highs. But here's the problem, and the opportunity for us as smart money traders. These zones are liquidity traps. When price builds up multiple touches at the same level, it's not a sign of strength. It's actually a setup. It means liquidity is stacking up on both sides of the range, and smart money sees that. If they want to sell, they'll first push price above the equal highs, triggering all the stop losses in buy stops, then quickly reverse the market and dump it back down in the original bearish direction. This concept is often called a liquidity sweep, and it's one of the cleanest, most reliable signals that smart money is active. So instead of following the crowd and entering on the bounce, we wait for the sweep. We let price take out the equal highs or lows, enter a key zone like a supply or demand area, and then look for entry with confirmation. This small shift in how you view equal highs and lows can completely change how you trade. Now let's move on to the third major concept, the market maker model. This is one of the most powerful frameworks in smart money concepts, and understanding it can completely shift the way you see price movement. Here's how it works. In every institutional price swing, there are two key types of liquidity: buy-side liquidity, sell-side liquidity. Buy-side liquidity is found above a high or a cluster of highs. That's where stop losses from short sellers are stacked and buy stop orders from breakout traders are waiting to be triggered. So when price starts pushing up toward that level, two things usually happen. One, bearish traders start protecting their short positions. Two, breakout traders go long, expecting a breakout rally. Smart money knows this. So what do? They create what we call a buy-side delivery, a sharp, intentional move upward designed to grab all the liquidity sitting above those highs. It looks like a breakout, but it's actually a trap. Once that liquidity is taken, smart money flips their positions and sells into the trapped longs, reversing the market. Let's flip that logic now and look at the bearish side. Sell-side liquidity exists below a low or a group of lows. That's where the stop losses of long traders are sitting, along with sell stop orders from breakout traders. As price approaches this level, you'll usually see 1. Bullish traders protecting their longs. 2. Breakout traders trying to short the breakdown. Smart money will once again engage in a trap, this time called a sell side delivery. Price is pushed down just enough to trigger all those stop losses and breakout shorts. Then, boom, they reverse the price upward and go long, leaving retail traders stuck on the wrong side of the move. The key takeaway, the market maker model is designed to hunt liquidity on both sides before moving price in the opposite direction. That's why it's so important not to chase breakouts blindly. Smart money isn't trading breakouts, they're creating them to trap retail traders. So instead of reacting to the breakout, wait for the liquidity sweep, identify the zone where smart money is likely to enter, and then align your trade with the real momentum behind the market. Here's another key insight that can make a big difference in your trading. When price starts forming multiple support levels, or internal structures just before it reaches a major demand zone, that actually increases the probability of a strong bounce from that zone. Let me explain why. As price moves down, creating small supports along the way, more and more retail traders start buying, thinking the market has already bottomed out. But what do they all have in common? They place their stop losses right below each of those support levels. And that's exactly what smart money is looking for. See, if institutions want to buy, they need someone to sell. And those stop losses are essentially sell orders, just waiting to be triggered. So when price finally hits that demand zone, all those clustered stop losses get swept, creating a surge of sell-side liquidity. Smart money absorbs that selling pressure and steps in with large buy orders, causing a sharp bounce from the demand zone. This isn't random, it's engineered. And here's the real edge. If you see a liquidity grab pattern, like a stop hunt or wick spike, inside your supply or demand zone, that's a strong confirmation that a short-term market structure shift is about to happen. After that, price usually doesn't just reverse aimlessly, it starts moving directly toward the liquidity on the other side of the range. So next time you're analysing a setup, don't just look at whether price is reaching a demand or supply zone. Ask yourself, is there stacked liquidity leading into the zone? Did we just sweep that liquidity with a clean pattern? If yes, that's your cue. Smart money just made its move and now you're trading on the right side of the market. All right, now let's talk about something that sits at the core of every smart trade, market direction, or in simple terms, who's in control right now? Before we do anything else, the very first step in reading any chart is figuring out who's dominating the market. Is it the buyers, demand, or the sellers, supply? Because remember, we always want to trade with the flow of power, not against it. So how do we determine who's in control? It all comes down to mitigations. This is the key mechanism in smart money concepts. Here's how it works. When price comes down and mitigates a demand zone, that's a signal that demand is taking over and buyers are stepping in. On the flip side, when price moves up and mitigates a supply zone, supply is taking over and sellers are back in control. Let's say the market is in a clear uptrend. You'll notice a consistent pattern of higher highs and higher lows. Each time price pushes upward and breaks market structure with inefficiency, it leaves behind a new demand zone. Now here's the important part. Those demand zones stay relevant until they get mitigated, meaning until price comes back to test them. When it does, that's your opportunity to follow the dominant trend and look for long entries. But what if price breaks below a demand zone instead? That's called a change of character, SCOTch, and it's a major signal. It tells us two things. 1, supply has now taken control of the market. 2, a valid supply zone has just been created. From here, the trend often reverses downward, forming new supply zones as it drops until price hits the next unmitigated demand zone. Now, this is where things get interesting. When price is stuck between a supply zone above and a demand zone below, we often see consolidation, a range-bound market. It's basically a tug of war, and whichever zone price breaks out of will show us who's in control next. So if you're ever unsure what to do, zoom out and ask, has a zone been mitigated? Was there a CHOC or B or OS break of structure? Which side is pushing price with more strength, demand or supply? This structure helps you trade with logic, not emotions. All right, let's break this down step by step. In this example, we see 3 clear bullish moves, each breaking above the previous high. And this tells us that demand is in full control. Buyers are pushing price higher, and we even spot an unmitigated demand zone, meaning price hasn't come back to retest it yet. This zone becomes a key level to watch. When price pulls back to it, we expect it to act as support. Then what happens? We get a short correction and boom, another break of structure to the upside, this time with imbalance, which forms a new, even stronger demand area. As long as price stays above the lowest demand zone, what we call the extreme demand, the overall sentiment remains bullish. But here's where things start to shift. Price comes back down and tests the demand zone again, but this time it fails to create a new higher high. That's a red flag. It means buyers are losing momentum. And once price breaks below the most recent low, that's your signal. The bulls are no longer in control. We might be entering a bearish reversal. Now let's mark the origin of this new downward move. The starting point of this drop becomes our new supply zone, and as price continues to break structure to the downside, that's confirmation. Supply is in control. From here, the market creates multiple supply zones, and each one offers a potential short setup, a chance to follow the new bearish trend. Eventually, price approaches a new unmitigated demand zone, a level where buyers could step in. And this is where things get interesting. Right now, we're at a key decision point. We've got supply pressuring from above and demand waiting below. This is where the battle between buyers and sellers takes place. So what should we do? Wait and watch. Be patient. Let price reveal its next move. This level might become a turning point for a reversal, or it could just be a temporary correction before the downtrend continues. And here's the final takeaway. We can't control what the market does next, but we can prepare for every possible scenario and let the chart tell us where to strike. Now let's dive into one of the most powerful tools in smart money trading, order blocks. Order blocks are not just random zones on your chart. They're refined supply and demand areas where large institutional orders were previously placed. In other words, this is where smart money made a move, and the market reacted strongly. Here's the key idea. When price hits these levels, it often gets rejected. And if price returns to that same level later on, there's a high chance it will react again. Why? Because there are likely pending buy or sell orders still sitting there, left behind by institutions who want to scale in or fill more of their positions. Now here's something really important. Every order block is a supply or demand zone, but not every supply or demand zone is an order block. Let me explain. Any strong reaction in price creates a supply or demand level. That simply means big players jumped in and pushed price hard in one direction. But if we traded every one of these zones, we'd end up with a cluttered chart and a lot of losing trades. So how do we filter out the noise? Through experience and backtesting, we've learned that only some zones consistently deliver high probability setups. And that's where order blocks come in. These zones usually share a few specific characteristics that make them more reliable than standard support or resistance levels. So before you start marking your charts, we need to know what makes a zone a valid order block. That's what we're covering next. I'll walk you through the exact criteria to identify a valid order block and then show you how to draw them properly, so you're not just guessing where smart money is sitting. Let's break it down together. All right, now let's break down the rules for a valid order block. This is where things get really interesting. The first two rules we've already touched on earlier in the video. 1. The zone must show inefficiency, meaning there's a price gap or imbalance. 2. It must involve a liquidity grab, where stop losses were taken out to fuel the move. But here's where the third rule takes things to the next level. A valid order block must break market structure. Let me explain. In a bullish scenario, when price pushes above a previous high and closes strong, that move isn't random. It came from somewhere. And that somewhere is your demand zone, but not just any demand zone. That zone is now responsible for flipping the structure of the market. It's not just a level, it's a powerful decision point showing that smart money stepped in and shifted control. The exact same idea applies in a bearish setup. When price breaks below a previous low and shifts the structure downward, the supply zone that caused that drop becomes significant. That's where the big players sold hard enough to flip the market. So here's the key takeaway. A supply or demand zone becomes a valid order block if it causes a clear break in market structure. Without that structural break, it's just another zone and likely not strong enough to trust on its own. This is what separates ordinary levels from the true high probability zones that institutions use. These are the zones we want to watch, mark, and trade with confidence. Let's look at some real chart examples next, so you can see how this works in live price action. Now let's take a look at this example. We're in a clear uptrend, and this right here is our most recent break of structure, which tells us that demand is still in control of the market. Each of these demand zones, they're all potential long opportunities. But here's where you need to be smart. The origin of this bullish move, the exact zone where price launched and broke structure, is the one that deserves your full attention. That zone is where smart money entered the market. It's your high probability setup. Now sure, the other zones may still offer entries, but they carry more risk. Why? Because they're more likely to get swept in a liquidity grab, especially if retail traders are stacking orders there. So what do? We adjust our risk management accordingly. Always remember this, a great strategy grows your account, but risk management is what keeps you in the game. Here's a solid rule to stick to. Risk only 2 to 3% of your capital per trade, and never have more than 3 open positions at the same time. This way, even if you take a few losses, you're not wiped out and you're still in the game for the next high probability setup. All right, let's talk about breaker blocks. One of the most misunderstood but powerful concepts in smart money trading. A breaker block is basically a failed order block that flips into the opposite. It turns a demand zone into supply or a supply zone into demand. Think of it like this. You know how in classic price action, when price breaks above resistance, that level often becomes support, or when support breaks, it becomes resistance? The same logic applies here, just smarter. Here's how it works. Sometimes a valid order block doesn't hold. Maybe the market structure has shifted, maybe price tapped into a stronger level on a higher time frame, or maybe it was just overbought or oversold. Whatever the reason, the order block fails, price blasts through it. That failed level, now it's a breaker block, and guess what? It becomes an area where the opposite side takes control. Imagine price pushes up and breaks a recent high, leaving behind imbalance. This move creates a bullish order block, and naturally, we expect price to return and react. But here's the twist. Instead of bouncing, price crashes through it. Boom, we get a change of character. Chop. Price breaks below the previous low with aggression, confirming that sellers are now in control. That failed demand zone, it's no longer demand, it's now supply. This is our breaker block. Why does this level often work so well? Because traders who went long at the original order block are now trapped. When price returns, they want to close at break even. At the same time, smart money sees this as a fresh supply zone and starts shorting. So now we've got trapped buyers exiting and fresh sellers entering. And that's what causes price to reverse hard from this zone. Let's wrap up with one of the most important concepts in trading, market structure. So what exactly is market structure? Think of it as the backbone of price action. It includes the swing highs and swing lows, supply and demand zones, and the overall flow of the market, also known as order flow. Now, the market usually behaves in 2 main ways, trending or ranging. In a trending market, price moves in one dominant direction, either up or down. Let's focus on an uptrend. In an uptrend, price pushes upward, forming a sequence of higher highs and higher lows. This pattern shows that buyers are in control and momentum is driving the market higher. Take a look at this classic bullish structure. Price keeps respecting previous lows and breaking new highs. This is what we call an ideal ascending market. And here's the key. During an uptrend, the market tends to break resistance levels and create new highs more often than it breaks support. Of course, price action isn't always clean. Markets can get messy. But even if you zoom into something as low as the 1 minute chart, you'll still see this pattern. Higher highs, higher lows, push after push.